let's see, what do our financial mutants, our clients in the wealth survey, what are they doing with car purchases, home purchases? Because these are some of the biggest things that go out the door on the expense category.
Well, not only are they, for most people, the most expensive things that you will ever buy, I think for a lot of Americans, they are the status symbol. The home that you live in or the car that you drive, for some reason, it's supposed to be this representation of how wealthy or successful you are. But when you actually look at the numbers, 81%, that's 8 out of 10 of new cars purchased in Q1 of 2025 were financed. Yep. So there are a lot of people that are borrowing money to get into the automobile. So again, we asked our clients, again, these are folks that have fulfilled the abundance cycle. They've reached a level of success that it made sense to take the relationship to the next level. And we asked them this question: on your last car purchase, how'd you pay for it? And 60% of our respondents said, okay, yep, on my last car, I wrote a check and I paid cash for it, which I thought was pretty exciting.
Well, that's always, cash is, we get a bad rap on this, is that a lot of people don't understand, just because we have a rule to help you finance cars, the preferred way to pay for cars, because they're depreciating assets, it's even hard to call them assets sometimes, is to pay cash.
That's right.
So it doesn't surprise me that our financial mutant wealth management clients are paying, the majority of them are paying cash, but also we have a no hypocrite policy.
That's right.
We know a lot of people, and I fell into this camp, is that when I graduated college, I was broke as a joke. I had a lot of opportunity in my eyes that I was going to try to change the world, but I didn't know how to do it. So the most important way that I could start my wealth building journey was to drive to my job. And I needed reliable transportation for that. So I actually had to finance my first car, and that's what led to 23.8. And not surprisingly, these same clients, who the majority of them are saying they pay cash now, when we then pivoted the question and said, hey, okay, we understand right now you're paying cash, but at the beginning of your journey, your first car, when you started working, did you pay cash or did you finance? And what do you know? 72% of them financed their first car.
That's 3 out of 4 folks who have now reached a level of financial success that they get to be part of this survey. So if you cannot pay cash for a car, that's okay. A lot of people have been in that same boat, but we still want you to do it responsibly. It's why, Brian, we came up with 23.8. When it's time for you to buy a car, whether you're buying new or whether you're buying used, if you cannot pay cash, make sure you follow 23.8. You put 20% down on the purchase. You pay it off in no more than 3 years or 36 months, and your total gross payments cannot exceed 8% of your monthly income. And then there are 2 caveats you have to keep in mind. Number 1, luxury cars don't count. If you're buying a luxury brand, if you're buying a BMW or Mercedes, an Audi, something in that family, you have to pay it off in 1 year. 1 year, same as cash, pay it off. And number 2, you cannot let your car payment exceed the amount that you have going monthly to investments and savings. So if you have $1,000 car payment, you better make sure that you have more than $1,000 going into your investments for the future.
Don't you wish all those videos on TikTok and elsewhere that have all the people who are bragging about their $1,300 car payment, if they could, underneath it, you could see and
how much am I saving?
Italicize what their savings rate is. That. It would be nice as an offset on that. But here's something, getting back to my financial mutants who are doing things right. I do think it's interesting if you're at least going to buy a depreciating asset, how do you offset that depreciation? Is you just drive it until the wheels fall off. And what do you know? When you look at the stats, 84% of our Abound clients drive cars for more than 7 years.
What I think is wild is when you think about this contrast, 84% of Abound clients drive it for more than 7 years. 63% of average Americans right now drive a car for less than 5 years. What that means is that 63% of Americans would prefer to pay for depreciation and then do it again, and then do it again, and then do it again. If you're changing out your car every 3, 4, 5 years, you are taking a huge hit in terms of how quickly that automobile depreciates, and you're literally flushing money down the toilet. So if you're gonna buy a new car, you should buy it with the intent and the idea that I'm gonna drive this for 6, 7, 8, maybe even 10 years, so that the depreciation hit I take on the front end doesn't matter so much by the time I get to the end of the car's life.
So we've obviously seen there's a big contrast between what financial mutants do with vehicle purchases versus what the general public does. How about the only asset that seems to show up when the Federal Reserve does their annual wealth surveys, or every few years they do their wealth survey. I keep saying annual, but they do their wealth survey. It seems like all net worth for the typical American is tied up into one decision.
Yep.
The house that they purchase.
That's right.
So what do our financial mutants do when it comes to housing?
Well, first, let's talk about what the median American does. We know that right now, the median U.S. home value is about $411,000. And so, again, our financial mutants are folks that have reached a level of financial success that it made sense for them to take their relationship to the next level. So we just asked, okay, what kind of homes do you guys live in? Is it lifestyles of the rich and famous? Is it these mansions, these amazing homes that you live in? And not surprisingly, we found that the median home value of our clients was about $650,000, with the average coming in just over $1 million. Again, that's skewed by some outliers on the high end, but you can see the vast majority, 70% of our clients have homes between $400,000 and $1.2 million. It's not multi-million-dollar homes that successful people are living in.
Well, I think there's even more to kind of look at this data and see. So yes, the houses are a little bit bigger than the median for the country, but it's not so much. It's
That's
really
right.
like 50% more. But then when you compare and contrast that, remember the opening slide was the typical net worth of a survey respondent was $2.2 million, and then you find out that their house is $650,000. Do you realize that we're getting within a stone's throw of that house was only 25%
fourth of it, yeah.
of their total net worth? Meanwhile, if you look at the average American, the only way that their net worth is actually increasing when you look at the Fed changes, the Federal Reserve changes, is by equity in their homes. So we already see a stark contrast, once again, that financial mutants understand that owning income-producing assets like your investments in your mutual funds, your ETFs, as well as other appreciating assets is more important than the house that you live in. There is something to be learned by that, because it's back to your army of dollar bills working harder than you can with your back, your brain, and your hands. Don't sleep on this. Yes, they live in nicer homes than the average American or the median of the American household, but it seems like they have more assets, much larger assets working for them in the background because they don't put too much value in the house that they live in.
But I can already imagine, Brian, the audience is saying something along these lines. Yeah, but times were different right now. Homes are more expensive. Interest rates are higher. These people, they put 20% down on their home, and we can't do that. And I want to remind you that, again, we are looking at people who are at a certain stage of their financial journey. But some of the information we can glean is, okay, what did it look like earlier on? And so we asked our survey respondents this question: when you bought your very first home, how much did you put down? What was your total down payment? And it was remarkable that 78, almost 80% of our respondents put down less than 20% for their first home. So if you're someone who's trying to buy your first home and you want to get on that side of the home ownership equation, but you've thought, man, okay, well, I've got to put 20% down, and I got to do a 15-year mortgage, and I got to. It's okay. We want to give you grace. And we think that even when it comes to buying a home, there's a better way to do home buying.
Yeah, this is, once again, people, when they ask us, when they come do studio tours and so forth, they say, where do these rules come from? And I always it's the no hypocrite policy. I mean, I've been around enough successful people, and I've asked enough questions, and I've had my own journey. We've had our own journeys. And I ask all of our financial advisors, how do you use and look at money especially for house purchases? And it's always the case is that it's easy to tell people, hey, you should go put down 20% on a house. But when you actually talk to successful people, the majority don't do it.
It's not what they did.
So that's why we created rules to help you just know what is the actual reality, not what's in the brochure, not what sounds good to make you feel bad about yourself. And that's why if you haven't gone out to moneyguy.com/resources and looked at our home buying calculator, we're going to help you kind of know how to navigate this difficult decision, but come out on the other end of it as best as you possibly can so that your future self, your present self, everybody is well represented and you feel like you've lived your best financial life.